A bit of a mixed quarter for Chevron. Profit falling a little short of what the street was expecting, but the revenue did beat expectations. Joining us right now is Chevron CEO Mike Wirth. And Mike, thanks for being with us this morning. I think the first thing I should probably ask you about, adjusted earnings per share came in at $2.06 a share. Street was looking for $2.11. What happened there?
Well, it was a good quarter, Becky. There are some accounting effects related to inventory that I think are difficult for analysts to anticipate that come in typically at the end of the year. But if you step back, it's a record year for us. We had all-time high global production, up 7% year on year, up almost 20% in the U.S. Record distributions to shareholders, $27 billion in cash returned through dividends and share buybacks, which is about $15 a share and nearly twice the nearest peer in our industry. And the good news is we're poised to continue to lead the industry in cash flow growth with another $10 billion in free cash flow growth over just the next 2 years at a pretty modest oil price of $70. And that's growth in the U.S. It's growth internationally, capital discipline, cost reduction. So we've got a very strong performance in 24 and momentum heading into 2025.
For that CapEx spending in 2025, you're looking to spend around $14.5 to $15.5 billion. I think that's the first time since the pandemic that you have cut spending. What are your plans for next year or this year, and how are you kind of thinking around those issues?
Well, in a capital-intensive industry, capital discipline always matters. We're looking for capital efficiency. We expect to grow production another 6 to 8% in 2025 versus our record in 2024, but we can actually do that at slightly less capital spending. So we're always looking for ways to become more efficient, which creates value for shareholders, and we can deliver strong production growth even as we remain disciplined and take spending down just a little bit.
Mike, I know that you all expanded production in Kazakhstan. That's been a bright point for what Chevron has been doing, certainly something you can crow about. But I think there are some big headwinds that are kind of hanging out there and things that people would like to see answers to, and I'm sure you would too. One of them has to be the deal with Hess. That was a $53 billion deal that you first proposed in October of 2023. It's been a long time that's been hung up in arbitration with ExxonMobil because of what they claim is their right of first refusal when it comes to Guyana. What can you tell us about where that stands? When do you think we'll have answers to this?
Yeah, we remain confident that Hess will prevail in the arbitration on that transaction and the arbitration over that joint operating agreement. Last year, the FTC approved the transaction. Shareholders approved the transaction, and the arbitration is set for May of this year. And the arbitration panel has indicated that within 3 months they'll render their decision. And so it has taken longer than we would have liked, but we've got a line of sight to resolution later this year.
What do you do in the meantime? Do you act accordingly? Does it allow you to kind of prepare for it, or how are you handling all of that ahead of it while you wait?
Well, you do the normal integration planning that is part of, preparing to combine two companies. We've had the time to go very deep in that, which should result in a very smooth integration of everything from assets and operations to information technology systems, people, business processes, et cetera. And so we've used the time well to prepare for that. And of course, Hess is using the time to prepare for the arbitration. And so we'd like to see things move a little bit quicker than they have, but we're putting the time to good use. And of course, in the meantime, you stay focused on the things you can control and all the rest of your business, which, as I just indicated, we close out a very good year and have great momentum going into 2025.
Yeah, you certainly have. The things that you can control, you guys are definitely firing away on all cylinders on those issues. Another issue you can't control is one that Secretary of State Marco Rubio brought up in his confirmation hearings. He pointed to just this idea that the United States could revoke waivers for oil companies that are doing business in Venezuela, waivers to the sanctions that are there. I think you're the only U.S. company that operates there. Have you spoken with the administration at all about this? And what would it mean if they did revoke that waiver?
Yeah, we are the only U.S. company with operations in Venezuela. We've been there for most of the last 100 years through changes in governments in Venezuela, changes in governments in the U.S. And over the last two administrations, they've both chosen to impose sanctions on Venezuela's energy sector. We work closely with both the first Trump administration and the Biden administration to be sure that they understand the impact of those on our company, on U.S. shareholders, and on the U.S. energy system. And then we stay in compliance with all the regulations that come through the Treasury Department on these things. And so we'll do that again. We have been in engagement already with the incoming administration, and it's an ongoing issue that we've been working at with both presidential administrations for many years.
Mike, this week, the Federal Reserve basically dropped the language where they said that the unemployment rate has stabilized at a low level in recent months. I just wonder what you're seeing from an inflationary perspective. You've got a pretty good feel for labor costs, for what it costs just for equipment and other issues out there. What are you seeing?
Yeah, inflation certainly has moderated from what we saw a couple of years ago. It can vary in different parts of our business. Onshore in the U.S., we certainly have seen relief. In the offshore and deep water, there's more pressure. There are fewer service providers, and the equipment's more specialized. There's been more activity out in the deep water, and so there's probably a little bit more pressure on that part of our business. But broadly speaking, we're certainly seeing some relief from what we saw in 2022, 2023.